I'm putting together deals, I'm really looking at it from two lenses. What's best for the deal to mitigate risk, and what's best for investors where they're getting a strong return without stressing the deal too much. And think about it this way. It's probably really attractive to put a 10 or a 12% pref return on a deal. A pref return is the investment hurdle that passive investors need to make before general partners can partake in the upside of the deal. So a higher pref return is going to be very attractive to limited partners or passive investors. The challenge with that is most deals are not generating enough cash flow to hit that kind of return, especially early on in the deal. So would it be easier to raise money with a higher pref return? Yes, it would, because it's going to be more attractive. But it would make it hard on the deal, because if you're not hitting that pref, then it's going to accumulate over time. And that's going to start to grow and become a bit of a hill that the deal is going to have to produce more and more cash flow to catch up to and overcome. So on the flip side of that, you have deals where maybe it's just an even split at some point. Maybe it's a 60-40 split. There's no return, there's no hurdle, nothing like that. We'll just share whatever we make. We make $10, you get 6, I get 4. And that's just how the deal operates. There's not a right or wrong way. What I will tell you is when you talk to your prospects, your passive investors or potential investors, you'll learn what they want. You'll learn what they're looking for, and you can merge ideas accordingly to deliver a deal structure that works. Our standard deal structure for a long time was a 70-30 split, 7% pref return, meaning 70% of the profits will go to our investors, 30% of the profits will go to the general partnership team, and we had a 7% preferred return hurdle that we had to meet before that 70-30 split kicked in. I think the market has shifted a little, so we still look for deals like that, but we've gotten a bit more creative on how we structure deals. I know some folks have done like a mezzanine or kind of a two-tiered position when it comes to the equity structure. You can do those things, but I would also tell you that the more complex you make it, the less likely it is for an investor, particularly a newer investor, to move forward. Because if people are confused, they're not going to invest. Like they don't want to feel like you're being tricky or trying to take advantage of them. So I would urge you to do the simplest structure you can do where you don't overly stress the deal and it makes sense for someone to invest. I've known people who've done very simple deal structures. I've known people who've done very complex deal structures. Ultimately, it comes down to the deal. It comes down to your investors, what they're looking for, and I would use that to guide the kind of structure you utilize.